This session on period end adjustments, we're going to have a look at prepayments. Now, just to remind you that when an accountant prepares a set of accounts for a year, they have to ensure that the statement of profit and loss includes all of the income that was actually generated in that period and all of the expenses that were incurred in that period. But sometimes what happens is that goods or services may have been paid for or invoiced for in an accounting period, but might be received at a later point. So they might be received in the next accounting period. And we'll have to make an adjustment where that occurs. Now, this approach is known as the accruals concept, where we match income and expenses to the accounting periods in which they occur. So let's have an illustration of this issue. Let's say that we have a business that's got a year end of 31st of December 2017, and a couple of months before that year end, it pays £1,800 for buildings insurance. And that policy, that insurance, covers the period from the 1st of October 2017 to the 30th of September 2018. So some of that policy covers a period in our first accounting period, the end of 2017, but the majority of it, 9 months worth, is in respect of the year ended 31st of December 2018. So we have to make some sort of adjustment so that the cost of the insurance falls into the right accounting period. Now, to solve this problem, what we do is we'll record an adjustment in the first period end to move 9/12 of that cost. So that part of the insurance cost that relates to the following accounting period, we'll move it out of the year ended 31st of December 2017. And this is known as a prepayment. And we will also make a reversal of that adjustment in the following accounting period so that that cost for that 9-month period is then recorded in the correct period, the period in which the cover was provided. So let's now have a look at an illustration of a prepaid expense, and then we'll look at an example of a prepaid income. So we've got a business with the year end of 31st of August 2018, and on the 1st of July it pays road tax of £360 for one of its vehicles. Now that road tax is for the 12 months ending the 30th of June 2019. So if we don't do anything, that £360 would be recorded in the cash book, and it would then be recorded as a motor expense in the nominal ledger. But of course, part of that cost actually relates to the year ended 31st of August 2019, the next accounting period. And if we look at that £360, actually 10/12 of that cost relates to the following year. So what we need to do is record a prepaid expense or a prepayment at the end of the year, that's on the 31st of August 2018, to move that part of that motor expense cost out of motor expenses so that it can then be included in the motor expenses for the next accounting period. So what are the journal entries going to be? Well, on the 31st of August 2018, on the year end, we're going to record the following journal. We're going to credit motor expenses with that portion of that 360 that relates to the next accounting period, and that's 10/12 of 360 or £300. So we'll credit motor expenses with £300 and we'll debit prepayments or prepaid expense account with £300. Then at the start of the next accounting period, so the 1st of September 2018, we will reverse that journal. So we're going to be debiting motor expenses with £300 and we'll credit our prepaid expense account with £300. So let's now have a look at an illustration of prepaid income. Now this is where a business has invoiced a customer or has received money from a customer for goods or services that have not been provided either in full or in part by the year end. So let's illustrate this. So we've got a business with a year end of 30th of November 2017, and on the start of November 17 it issues an invoice for £6,000 to a customer in respect of a 12-month maintenance contract, and that contract covers the period from 1st of November 2017 to the 31st of October 2018. So when we look at this contract that's been sold, only 1 month of that cover falls into the business's year end of 30th of November 2017. But of course the invoice will be recorded in the sales day book for November 2017, and if we do nothing, the whole amount of that sale will be included in the business's accounts for the year ended 30th of November 2017. So we need to make some adjustment to our accounts, and in this case it would be a prepayment at the end of 30th of November 2017 to move that part of that £6,000 that relates to the following year out of sales in the earlier accounting period and into sales for the next accounting period. That would be the year ended 30th of November 2018. So how are we going to do this? Let's have a look at the two journals that we would record. Now at the year end we would record the following journal. So on the 30th of November 2017 we would debit sales revenue by 5,500, so we're recording a reduction there in our sales revenue for the year, and we would credit our prepayments account with £5,500. Then at the start of the next accounting period, so on the 1st of December 2017, we would record another journal, and this other journal would reverse that previous journal that we've just recorded. So here we would debit prepayments with 5,500 and credit sales revenue with 5,500, and that way that prepaid amount of 5,500 is then going to be recorded in the correct accounting period. And that is how we go about recording prepayments.